Gentle readers, welcome to Everything is Everything. I'm Amit and this is my good friend Ajay. And today I want to tell you a story about Ajay. You look at Ajay right there and you see a man who is a picture of repose, a calm man, completely controlled, exactly like that. Yeah. Absolute Shanti person, as it were. But still waters run deep. So Ajay and I run this course called Life Lessons. We are opening up our September cohort soon. That'll be our third cohort, so do join. We run this course called Life Lessons where he teaches a module on personal finance. It is a legendary module, right? People could have written songs about it, made films on it, written poetry on it, but they haven't because it is too legendary even for that. It is that legendary. And therefore, and quite seriously, he is known for that subject, and people will often come to him for advice on their finances. And one friend of mine got in touch with me. He said, listen, you know Ajay Shah? So I said, yes, that is true. I know the man. He said, ask him a question for me. So I said, okay. So then he asked me what question to ask. So this is asking for a friend, but like literally, because I don't want to know this. But he asked me to ask you a question. So I went and asked Ajay Shah this question. And violence resulted. This is his reaction. And then once again, I went to him and I asked him the same question the next day. I thought, let me see if he is like softened to the idea. This is his response. And then a third time I tried and he responded thus. And then finally, he said, Amit, I have hurt you enough, enough violence. I shall answer the question that your friend has for me. I shall do an entire episode on it because it is a stupid question, but it is an important question because people have it on their minds. What is that question, Ajay Shah, which made you so angry?
How much wealth do you need in order to retire? I am a man of peace. Make episodes, not war.
So, Ajay, what's wrong with that question?
When you pause to think deeply about that question, there is no good answer. And when people align themselves around a sense of security and safety around a number and they achieve that number, then people are setting themselves up for grief. Okay, let me make the argument that it's actually the wrong question to ask. And if you fall in love with an answer, then beware of getting what you wish, because actually the world is more complicated than that. Okay, so I want to get to fundamental insights and reasoning around the lifespan, and there is a body of knowledge that will just help all of us. And the quick summary is that's a bad question. What you need is a more process orientation, and we need the wisdom of accepting forces beyond our control. We need the wisdom of accepting uncertainty about the world. Okay, so let's get going. So the first idea that you and I have been great champions of is the problem of longevity. Longevity is going up, longevity will go up, and we're going to live more than we think. Our health span is going to be better, our lifespan is going to be better, and that poses a profound challenge for everything. Okay, so in the hunter-gatherer age, the average human lifespan at birth was like 30, 40 years. And people died quickly. Then there wasn't that much to do. You kind of grew up and you rapidly died. We in the modern world are stressing the human body to do things it was never designed for. So it's really an alien landscape to live that long, and it challenges us. It is certainly out of touch with all traditional culture. So the wisdom of traditional culture is again oriented towards, medium lifespans, that in the age of agriculture, you died by 50, you died by 60, and nobody really lived beyond. Whereas a healthy, affluent person in the world today has to cope with an unbelievable lifespan problem. Okay, so young Namsita here, who is all of 21, has to realistically think that she's going to be a little old lady walking this earth at 121. It's not at all a radical proposition to think of her being an active little old lady, okay, doing paragliding at 121. So this is a different world altogether. We're not ready for it. We haven't thought about it. Traditional culture is not ready for it. So our traditional operating system is ill-suited for this world. And one part of that is the role of family support. That traditionally people had kids and kids took care of them. You lived near family, and there was an entire support system in old age that came with that. Now, the institution of the family is in decline. People are having fewer children. People are spending less time with family. We are all with chosen family of our own in various ways. And this again raises questions about what does it mean to grow old? What does it mean to have this radical extension of the lifespan?
Yeah, that's a very wise point. And I came across this interesting bit of trivia yesterday, which I should have known because I follow governments very closely and I know all about the growth of the state. But Japan now, apparently, in fact, for a few years, has a minister for loneliness, which is really meant to be for old people because they are, of course, having, the opposite sort of demographic transition that we are having. There are tons of old people. There are questions of loneliness. So the minister's job is to like organize Scrabble tournaments and Carom tournaments and all and keep old people occupied, etc., etc. Very much a first world kind of problem. I think Indian problems would be very different. Like, when I think of that particular question, I think there's also a deep mindset problem there which people have to think about. And the mindset problem is that people are looking at life almost as a destination and not a journey. So it becomes a sense of, okay, I want to get to the place where I have so much money and then I retire and I sail off into the sunset. And but that's a very dangerous way of thinking. Like you spoke of process orientation, life is a continuous process. We're going to keep on living. We are not going to be unhealthy and, we're not going to get, we are probably going to get dementia at some point. Like my biggest fear is that I'll live longer, but more of it with dementia. Dementia will come when it is supposed to. So like for 30 years, I won't remember my name. That's a terrible thought. And that should not happen. But I completely buy your point that for younger people, you can imagine a longer, healthier life. And then how do you think of it? And the mindset change is completely radically different. So, Ajay, but getting back to the question, at the heart of that question, and the question may be faulty in terms of the framing that what is that one big sum and I can retire, and younger people might say, what is my FU money, etc., etc. But the framing might be wrong. But the worry is very much valid that financially, what do I need to do to sort of make sure that as I go along, I don't run into trouble?
Yeah. The heart of good thinking in terms of financial planning is equity investment. Uh, the magic phrase is the equity premium. The equity premium is the higher enhanced rate of return that you get on average in return for holding diversified equity assets. Okay, so the universe does not pay you to take foolish, undiversified risk. But once you've finished with all the standard hard work of diversification, then after that, you are bearing systematic risk that nobody can solve. Then you get paid a risk premium for bearing that risk. And this is the superiority of the long run average return of equity indexes. And there is a lovely counterpoint that on one hand, we have a gloomy world where longevity has gone up and we face all kinds of financial planning challenges because our time horizons are so great. But equally, those long time horizons give you the power of compounding with even more potency. So, if roughly speaking, you think that in equity assets, you're going to get a real doubling every 10 years, then in 20 years you get 4x, in 30 years you get 8x, in 40 years you get 16x, in 50 years you get 32x, and so on. So in a way, the counterpoint to the longevity problem is the equity premium problem. So in a interesting and weird way, the privilege of hanging in there for long decades, riding the ups and downs of the equity market. There's no guarantee. It's not a fixed income asset. You're not going to get that return for sure. On average, you'll do well if you're in equities. But if you can manage to hold for 30 years, 40 years, 50 years, 60 years, then the ups and downs are more likely to cancel out. And you will get the pure equity premium as a signal that will come through over long periods of time. And that sounds absolutely great. So the basics of financial planning are have a high savings rate and go into diversified equity investments. Now, in this, there are two pieces of magic. The first of them is that small changes in the expected rate of return really get magnified over long time periods. So the size of the equity premium matters. And it's like you can't be philosophical about it. It makes a huge difference when you start doing your rough calculations. Then you will see that the size of the equity premium that you're willing to assume makes a huge difference to the kind of calculation you end up with. And the second is the role of diversification. Okay, so I already said that you don't get paid for just taking risk dumbly. You get paid a risk premium for taking a diversified risk that cannot be wiped out by mere diversification. Well, you want to go up from one company to many companies in one industry, that's diversification. You want to go up from one industry to 20 industries, that's diversification. But then the biggie is you want to go up from one country to many countries. So we should be holding equity index funds of 20 countries. Why stop at one country? So that you get the gains from diversification. You know, the United States has some bad decades, Japan has some good decades. On average, it all cancels out. So that's a huge gain that we get. Roughly speaking, the risk adjusted return on globally diversified equity portfolios is about 2x superior to being in India alone or being in any one country alone. So that's another huge frontier that we should care about small dribs of changes in performance. It really makes a difference because of long time horizon. And the second is risk reduction. That is, this is a free lunch. Instead of sitting in India, you diversify all over the world. It's a free lunch. Why would anybody ever be stuck in one country? Okay, so this is the basic catechism of financial planning, that have a high savings rate, be invested in diversified equity index funds, not in individual assets, and spread your money all over the world. Have 20 countries and put 5% in each of them. So having excessive investment in any one country is a mistake. It's like you're leaving money on the table because you can get a risk reduction for free. Roughly speaking, you will hold the average rate of return intact and you will get a reduction in risk. It's a free lunch. Why would you never do that? And now I want to again connect this up to time horizons. If you have 60 years and you're invested only in India, it gives you time. There'll be ups and downs. There'll be, a 40% drawdown when there'll be bad years and it'll come back up. And over a 60-year period, you're fine. But suppose you only have 20 years, suppose you have only 30 years. Now your risk tolerance is lower. Answer: international diversification. So then it is even more crucial to spread your money all over the world. So you can be philosophical and zen and, like take life lessons, do more Buddhism, become detached. Okay, all those things will protect you because there'll be ups and downs and you'll be fine. But if you don't have too much time, then all the more why you need to be globally diversified.
So let me come at this from the layman's perspective or from the perspective I would have had maybe 20 years ago.
Yeah.
Because 20 years ago, had I, for example, attended your personal finance module in our life lessons course, it could have changed my life. It would have made a big difference to me. But at the same time, I don't think I would have understood the concepts in it or even been receptive to it. Because a typical Indian middle class mindset is this, that you go out there, you get an education, you have a career. I mean, I did very unconventional things, but it was still an education and it was still a career, although, no connection between the career and the education. But you do your things, and that's your human capital. You're learning stuff, you're getting a salary, the salary goes in the bank, you put it in fixed deposits if you want to be safe, or you put it in a savings account. And it took me a long time to realize that all of those are a losing proposition. Inflation itself is so high that if you effectively keep your money in a savings account, which I actually did for the longest time, you're burning that money. You're actually losing money, your wealth is going down. And ideally, what you want to do is not just rely on you're being able to work for a living, but let your money work for you. Whatever money that you make, you'll make that work for you. And equities are obviously the way to do so. But the Indian middle class mindset, the moment you say stock market, the moment you say shares mein paise dalo, you immediately start thinking risk and the danger of losing everything, which is absolutely not the case. So I think a lot of what you just spoke about, the people receptive to it are people who would already have some sense of finance and who would understand these basics. But for a lot of people, like the way that I was, all of this is news. That, what do I do about the risk? Equities mein kya? Like, I don't have the time to sit and buy individual shares and all of that. To which you would say that just buy an index fund, you'll do well over time. To the question of risk, you would say just diversify, etc., etc. So is that a sort of a correct paraphrasing of?
It is a huge problem. You have pinpointed an important issue. In the United States, there are sweet papers which tell a story of inequality, that the households which on multi-generational horizons get to equity investment just get that compound power of the wealth of the household grows generation after generation, and the households that don't get stuck. And then you get this massive separation between the wealth, and that shows up as wealth inequality. But it is really critical, family by family. We have to shift the risk culture, we have to shift the knowledge, and get to equity investment. So, if you think of the great rising gulf between the Gujarati and the Bengali wealth, then this is clearly a major factor shaping that problem.
That's a very low blow. We have culture.
Our good friend Amrita Agarwal has been saying something radical to me lately, and it's perfectly correct. But once she puts it like that, it comes as a shock. She's been doing these kinds of spreadsheet calculations, and she says this to me upside down. She says, if you don't have access to equity investment, it is not possible to do financial planning. So her proposition is not that we should be wise, we should hold equity index funds with global diversification. It is that if you don't do equity premium, it is not possible. So she says there's no way you can make these numbers square for any normal affluent person, and you are like permanently shattering your lifetime possibility. You're going to be miserable in old age if you fail to do this. So it is that important. It's not just a nice to have, it is essential. The only way to cope with longevity in the modern world and a range of problems I'm about to describe, the only way to build a sensible life design is to have a high savings rate, to have equity index funds diversified all over the world. That's the recipe which works. That's the only recipe that works.
Gentle reader, he mentioned the word spreadsheet, and it is common for spreadsheets to be floating around. You'll find hazard YouTube videos, how much you need for retirement, and they all give you spreadsheets to play with and all that. So I told Ajay we must also give a spreadsheet, and he was against the idea because he says the question is daft to begin with, but on thinking harder about it, he decided that, yeah, we'll also give us different kind of spreadsheet at the end of this episode. So watch out for that. Ajay, speaking of faulty spreadsheets, break down for me why that approach doesn't work. Because to many people, it seems like a beautifully easy way to figure out how much you need at retirement. You take a spreadsheet, you figure stuff out, you punch some numbers in, and boom, you got what you want. Why doesn't it work?
There is a list of deeply wrong aspects of these kinds of spreadsheet calculations. The first is about uncertainty. Nobody should ever make the mistake of taking a long run average historical nifty rate of return, like 13% nominal in INR, and sticking it into a spreadsheet and then thinking calmly, smoothly, okay, this will keep on happening into the deep future. You only get paid an equity risk premium because you're taking on a high level of risk. So there is huge uncertainty there, and to gloss over it is a mistake. So people get the wrong idea that I've got some smooth, happy path to paradise. Actually, you don't. You're bearing a risk. Things can go wrong. On average, things will go well, but you can't predict what will go wrong, and you actually want to think about it in a probabilistic way that there is a range of outcomes. This is the first thing that we have to think about. The second thing is think of the time horizons. Okay, so if you have 100 years in front of you, if you have 50 years in front of you, 50 years is an insane amount of time. We just don't know enough about the world. Recently, for Everything is Everything, we made this episode, The World in 2050. That's a scant 25 years out. By the time you're discussing 25 years out, we're doing science fiction sounding things. Okay. And I bet there are many readers who will just put us down saying, this is idle, pie in the sky. Okay, this is people just sitting around and shooting the breeze. No, we're dead serious. Gentle reader, Amit and I seriously believe every one of the claims we make about 2050. These are not casually done. We're trying our hardest. We take it seriously. That's only 25 years out. What will 50 years out be? What will 75 years out be? The world will be unimaginably different. How are you going to plan for that world? Now, in that world, some things are going to become very cheap, some things are going to become very expensive because there's so much technical change, right? So here is a rough way of thinking about it. Anything that can be made by machines will just like crash to nothingness. So you have a modern fancy mobile phone. Okay, this is a phone where I have paid 20,000 rupees for it today. This level of capability will assuredly be at 1,000 rupees. It is no question. It's just a matter of time. The mass manufacturing will happen. The robots will make stuff, and so a whole bunch of things. Okay, this table, the shelf, the manufacturing of the books, the manufacturing of the paper, of the ink. There won't be CDs anymore. This will be museum pieces.
There are no CDs anymore. Those are museum pieces.
Okay, so anything that can be done by machines will become dramatically cheaper, which is cool. It plays in our favor. So you're doing financial planning and deep in the future, those things are becoming cheaper. Wow, it's cool. Okay, on the other hand, the things that are done by people will just keep escalating in price because that's the meaning of GDP growth. When you get GDP growth, wages go up. And so the price you will pay for a cook, for a driver, oops, driverless cars, scratch that, right? Because the cars will be driverless. You won't need a driver, done. Now the car is just a robot, it's a machine, and those prices will go to zero. But anything that requires a human being, now you'll start saying cooking robots. So anything that can be done using things will actually become very cheap. But anything that requires human attention, human effort, personal services will go to infinity because you're fighting with GDP growth, that the wages of people are going to go up. So whatever you think you're used to paying for a doctor today, the price of a doctor will go up. There is a technical name for this. It's called Baumol cost disease. The great economist William Baumol figured this out, that in every economy there's a tension between things that are a little more labor intensive and services oriented versus things that are a little more goods oriented, and the relative price between the two will keep on changing into the future. That the amount of steel you have to pay for a doctor's consultation will constantly become expensive because steel will get better and better. As the years go by, we'll make steel for less, but the price of a doctor will go up because there's no great pathway, and then you are up against GDP growth. The growth will drive up the wages of the doctor, and you get to this problem of inequality also with doctors, that really you want the best minds of society to be your doctor, and so then you're running up against that skill escalation at the top end of society, and so doctors are going to become more and more expensive. Okay, so you think that in old age you will want healthcare services, you will want personal services. How's it going to go? We don't know. Okay, so on some respects, things are going to get magically better. There will be a robot that will do your stent surgery. And then when there are human beings involved, that cost will go to infinity. In Japan already they are building robots that will give you a bath, which is supposed to be one of the loveliest things you can do for an old person that is not strong enough to take bath by themselves. Okay, and that you could think of as a personal services problem. Well, it's going to be done by robots in the days to come. Things like that. I'm not here to take a stand on the idea that your life will become very expensive. I am here to take a stand on the idea that we don't know. So it is an illusion of calculations. When you put up these two streams, you put up my expenses, what will the expenses be in the future? You put up my wealth, and you have some illusion of fixed numbers that this is the kind of return I will get on my portfolio. Both these columns bother me. You actually don't know. And we will have to keep on endlessly adjusting. Like, look, apples and oranges, apples become expensive. You can't hanker for apples. You just quietly adjust. You are human, right? We keep rethinking our optimizations based on prices. That the things that involve more personal services that will become more expensive, we will de-emphasize those kinds of consumption. The things that involve goods and become very cheap and are mass produced, we'll buy more of them. We are human. So we're not letting go of our faculties just yet. And we will apply our minds at dates deep in the future, and we'll figure out that world. And I'm unhappy with this illusion of calculation because it presumes that you know everything, you know what you will spend. There is one most important thing which you don't know anything about, which is you, which is your heart. What will your preferences be? Humans are notoriously bad at understanding what you value. So, I mean, think of your age today. If at age 20, I had gone to young Amit Varma and asked him to describe a good life at age 52, okay, do you think he'd have come up with good answers?
He wouldn't, and I will elaborate why after you finish, but please
Okay,
continue. Yeah.
yeah. So these are three strikes against this illusion of control, that you don't know about the way in which financial markets will husband your wealth. You don't know about the cost of your consumption basket, and partly it will change, partly you will re-optimize given the vector of prices prevalent at future days. And third, you don't know your heart. You don't know what you will want. You don't know what you will value. You don't know your notions of consumerism, of your notions of spirituality. So by the time you're talking enough decades in the future, it's actually a fog. And then I start thinking it's actually counterproductive to think too deeply about making some calculations. How much money will you have? I think the amounts of time we are discussing are unfathomable. And there is no way to have an illusion of control around those kinds of time horizons. And so then it's better to let go, that we don't know, we don't control. So we'll have a process orientation. We'll save money, we'll hold equity indexes, and we'll deal with the future as it comes.
This is a profound point, and the reason the 20-year-old me would not be able to figure out the preferences of the 50-year-old me is that there are too many unknowns in the future. When I was 20, I would never have known that, hey, we'll have smartphones and we'll have AI, which will turn image into video and etc. etc. And all of this would be completely baffling to me that I can, the means of production are in my hand. I can make YouTube shows, I can make movies if I want to, I can read any book or listen to any album at a moment's notice. Absolutely magical. And that to me is a core takeaway from what you are saying. Not that the future will be better or worse, so I believe it will be better and I'll elaborate why, but that it is fundamentally unknown. So to today put values in an Excel sheet and imagine the world will stay the same is nonsensical. As far as the technology changing everything is concerned, yes, it will. The kind of jobs that will exist 50 years from now are completely different, and everything good that happens because of new technology is always in the domain of unknown unknowns. When before mobile telephony came, India had a million STD booths, as you've pointed out, right? Today we have none. Those jobs were lost. Was it a loss? No, because the economy grew massively, productivity grew. Those jobs sprouted up elsewhere in ways that we couldn't have imagined then. But it was all pretty awesome. But the important thing is that it was all unknowable at the time, and to imagine that you can that the future is something that you can linearly extrapolate from the way the world is today is, I think, just stupid. It's you have there will be unknown unknowns, and all the unknown unknowns that come through technology and in the economy, I believe will be positive because that's what history has shown us. But I believe that there are negative possibilities that can also take place, and a lot of those have to do with politics and geopolitics and what is the state like, what are the institutions like, will inflation remain stable, what if inflation goes up massively, what if you have a war, what if you have hyperinflation, what happens, your savings get wiped out. We cannot take any of that stuff for granted. So that larger lesson that the world is deeply complex, so don't do simplistic planning on the basis of outcomes and fixed amounts, but instead think about a process of living your life, so you're always kind of okay.
I agree with everything you said. I think it is insecurity in our hearts which prompts the yearning for control. We want control, we want certainty because we are weak and we are scared. Actually, we have to find the culture, we have to find the operating system of being calm and confident and comfortable about ourselves. And then we are ready to navigate the uncertainties of the world, and we humbly accept the radical uncertainty of the world, and we say to ourselves, look, things will happen and we'll figure out as we go, but I'm not going to try for an illusion of control where I've got everything locked down. So it's a double problem. That one is, you are playing the wrong culture when you demand control, that I have this certainty, I have assured myself of ABCD. It's pushing concepts of control in your mind which are actually the wrong culture. And then second, you approach the future with all this optimism and confidence that I calculated I needed X money to retire and now I'm going to go travel the world. And you got that X money and you started traveling the world. Well, it will go bad because the world will surprise you. There is uncertainty in the world. The future is unknowable. And then you're setting yourself up for sadness because then you think you have the sense of entitlement that, I did all my homework, I made all my calculations, I gathered up my wealth, and then the world changed on me, and you will just be unhappy. So it is far better to not ask that question. I mean, you do need to do your hygiene. Each of us need very high savings rates, and we need to hold diversified equity indexes of 20 great democracies of the world. Okay, beyond that, we can't control what will happen, and trying to do calculations will not be wise.
So, Ajay, when I listen to you say all of this, and these are words of wisdom, and I agree with all of this, now give me some actionables. What can I do?
Okay. So the first thing I want to push to all of us is we have to get out of the word retirement. The word retirement is an industrial age idea that you would retire at 55 and you would die by 60. And it's a completely wrong concept. The idea that you want to look forward to not working is something that is an unhealthy thing to do. In the hard data, we know that when people step out of the mainline labor force, if they go into true retirement, they get a rapid health collapse. And actually, your life becomes horrible. Whereas if you stay engaged in the world of work, if you stay engaged with other people, your life actually becomes better. So I think all of us have to get out of the word retirement. We can change. We should change course. That you don't want a 9 to 5 corporate job, by all means, change course. Choose a new way of life. Okay, go live in a village in Himachal Pradesh and so on. But stay engaged with people, stay engaged in the world of work, keep doing stuff with every last drop. So that again is militating against the idea that I want a number and I will retire. And I'm just saying, don't get into the word retirement. Yeah, if you hate your life, the answer is not idleness. If you hate your life, the answer is to reinvent your life. That don't try to walk away from a bad life and say, I'm going to retire. Instead, say, I'll walk away from a bad life and I'll make a better life. So don't phrase it as an exit from an engagement in the world of work with a pot of money, and then I will earn an annuity and I will be idle for the rest of my life. And we've already discussed the basic life process, which is we should all have a very high savings rate. Okay, it is healthy and wise to save a lot. Have a high savings rate, put your money away into diversified equity index funds, get your money into 20 great democracies of the world. Okay, so go to the Freedom House Index, take the top 20 good countries with the best democracies of the world, buy their index funds. That's it. That's your process orientation on the financial management side. Now, in this, I want to talk about women. Okay, financial planning needs to be done differently for women, and here are a couple of elements that we need to think about. The first is that women have higher longevity. Okay, so men die early, women live longer. So there is a different edge on the problem of health span and lifespan when it comes to the way women think, and the optimization of women is different. The second problem that we have to think is that in the traditional culture, money is not supposed to be a girl thing. Okay, and this is deeply harmful. So women are used to handing over their financial planning problem, or indeed their entire assets, to menfolk, and this is just unwise. I think that women need to be financially independent, need to develop their own wealth, need to develop their own knowledge. Women need to take interest in the questions of how much saving, how much lifetime financial planning, what is an index fund, who are the top 20 countries of the Freedom House Index, how do I get my money out into the index funds of these 20 countries, who is my service provider in London who is doing this for me, what is the name password of that website. Okay, so the idea that most women have is that I'm not a person that has knowledge about money. This is a deeply damaging idea. Every woman should do her own financial planning and savings and investment, and it is an integral part of standing on your own feet and facing the world with confidence. Because if you don't know all these things, you lose confidence, and then you start getting into that whole spiral of insecurity and fear, and it's much better to get this out of the way.
I have an observation and a question. And the observation is really the point you made about retirement, where I've observed exactly what you alluded to, that I've seen people who've retired at exactly the same age, and one person is just sitting at home and they wither away and nothing happens to them, and another person keeps themselves busy. Maybe they volunteer at a dog shelter, maybe they start giving tuitions to people, but they keep themselves busy and engaged with the world, and they are much healthier and they live longer and they're happier and etc. etc. So one, that engagement is important regardless of the tag of being retired. And secondly, as a framework, retired is deeply problematic because every single person has something about them which others would value. And therefore, at any given point in time, there are ways for them to make money, whether they are part of the gig economy or whether they provide value to the world, they'll get value back, there will be double thank you moments. So really, no one retires till they die, right? So just thinking of it in that way can damage yourself. You can be toxic to yourself when you say that, oh, I'm going to retire, because in a sense, what you're really saying is, oh, I will be no good in this world and I will just withdraw from the world. And that's not how we should look at our lives at any point in time.
Yeah. This is on the firms of the world and the firms of India, that there are two great $500 bills lying on the ground. One is the women at work that want flexibility to be away from work. Okay, so women with kids want time at home on their terms, and it is on the firms to figure out how best to utilize all that wonderful brain power. And the other is older people who are no longer happy and interested to show up at 9 a.m. every day, but have a fund of knowledge, expertise, and energy. And I believe that it is on the firms to figure out how to use these opportunities. There are incredible opportunities available in India today and all over the world. And firms need to redesign their own production process on how to utilize these two kinds of resources.
My question is this. When you spoke about women, of course, I agree with everything. It's a deep problem within Indian society that women feel that, hey, money is not really my thing. And I've seen even educated people, even CAs and MBAs, leave the financial bit to their husband and etc., which is bizarre. But a question that people could ask is that, look, being a woman, my life is actually harder than my spouse, because not only do I work, do I go to office, do I do all of that, but my other responsibilities, the unpaid labor which the typical Indian woman has to kind of go through, takes up a lot of other time. Maybe I have kids, maybe I don't. I have to look after the house, I have to look after my in-laws, I have to look after my parents. It all piles up. Where is the time for me to think about finance? So what are the quick fixes by which, without using mental bandwidth and without trying to learn another new domain, how do equities work, how, what can I do? So without possessing any of the time and the mental bandwidth to be able to master all of those things, how do they invest wisely?
When when in life lessons, what we do is we pose the financial planning problem as akin to a health and well-being problem. That the point is to establish some good rules for living which do not make demands on your bandwidth and that get a reasonably good job done. So we are absolutely not advocating that you need to be thinking about individual equities and buying this and selling that, and absolutely not. We need to do some basics, but people do need the basic hygiene of understanding the pitfalls of the traditional Indian ways of putting your money in a bank or buying real estate, and the importance of equity indexes, the importance of global diversification, and then how to operate these accounts. So modern firms like Zerodha and the global firms do an excellent job. It's not complicated. It is like 3x harder to use Zerodha than it is to use Zepto. Okay, so it's not complicated. Anybody can do it. The point is we just have to wake ourselves up and take effort and take interest that, look, this is my life. So just like simple rules for living to be healthy is everybody's work. Like everybody needs to take interest in it. You can't outsource that. You need to have your basics right. And that doesn't mean be a health freak, a fitness freak, of devoting considerable bandwidth every morning for what are my health activities of today. No, like you've got to live in higher places. We should be composing symphonies. We should not be getting mired in all this, but we do need these basics. So I think of personal finance hygiene as being exactly like health and well-being hygiene, that we do need to take the trouble, the fixed cost of learning these things and establishing the drill and the guardrails. And then after that, the average hours spent per month on these activities, on a personal finance activity, should be like 15 minutes per month. Okay, this does not take time. You're not putting large chunks of time. It is a fixed cost of developing the basics. And as you know, you and I have been pushing these kinds of ideas a lot.
So what you're really saying is that in the context of health, for example, it's about establishing good habits like, okay, I want to sleep my 8 hours a day or 7 hours or whatever lets me wake up naturally without an alarm clock. I want to get my sleep. I want to exercise a little bit, maybe 6,000 steps a day or whatever. I want to eat reasonably healthy meals and not go overboard, however I define healthy. And once those things are in place, they're reflexive to me. I'm not even thinking about them. So similarly with finance, if I get into the reflexive habit of say just two things, and I'm thinking aloud here and tell me if you agree that one, I save a certain healthy percentage of my income every month, and number two, I can just put it in an index fund. I don't have to think about ye stock ya wo stock. Just put it in an index fund, and that's good enough. That'll do the job for you if you don't have any more time.
And once we wake up our mind, if you just look at the kind of money people spend on restaurant meals and alcohol, okay, you just get that out of the way and target it into savings. Suddenly you've got a life transformation on your hands. So it's about waking up, it's about opening your eyes.
Sir, alcohol though I don't have, but Swiggy is surviving in India because of me. Why do you want to mess with them?
Yes, I want you to make boiled vegetables.
Very sad, very sad. So, Ajay, at the start of the episode, you mentioned that it's like one way of diversifying my equity holdings is through an index fund. That's diversified. But the other way you said is invest in different index funds in the the growing economies of the world. So, explain that to me. How do I do that from India, and how does that play out?
Let's look at the experiences of some countries just to fix intuition and so we understand what's going on. The traditional, successful, mature, advanced economies are the United States and the UK. And everything that I have described, that story works out over the last 200-300 years. Okay, there's been a First World War, a Second World War, a Cold War, but these basics have worked. That you have a high savings rate, you buy diversified equity index fund portfolios, and those countries have high levels of freedom. So it is easy to spread your money all over the world, other than a narrow dark period when there were capital controls. Okay, so capital controls originated with Hitler in 1933, and by the late 70s they were gone in all the rich countries. So barring that period, they've always been open, saying the people are free. Okay, you are free to do whatever you want with your money and spread it all over the world. So it's a very basic feature of the freedom agenda, that people should be free to do what they want with their money. It is your money. It's not for the government to tell you what to do with the money. It's a Magna Carta right, that it's your money and you should use your money as you like. Okay, let's turn to Japan. In Japan, there was a giant mess in the Japanese macroeconomy through the 70s and the 80s, which led to a great crash which began in 1986. Okay, the Japanese economy is surprising in that for a very long time after 1986, the equity market just did not deliver. So there was a 20-year period where equities did badly, and it is scary. If you were a person who was investing through that period, then you really got a terrible and abysmal performance of your equity portfolio. But Japan was an advanced democracy and there were no capital controls. The Japanese government did not interfere with the freedom of their people. So, what you could do as a Japanese person was to spread your money all over the world, and that was your rescue. That the way to protect financial planning through the very unusual catastrophe of the Japanese economy from 1986 to 2006 to 2010 was global diversification. So, recipe one of holding an equity index fund portfolio would not have worked well in Japan for that period, but recipe two would have worked. Go to the Freedom House list, find the top 20 democracies of the world, buy their index funds. That recipe would have worked in Japan. Okay, next we turn to China. This is a really bad situation, and gentle reader, you should see the EIE episode of The China Model is Broken, and this is integrally connected to that story. China is supposed to be this fast growing economy, but it is singular in being a country where equity index performance has not happened. It's just bizarre. How can you get this kind of high growth in a country and not get the equity index performance? Okay, so conceptually, maybe two things have happened. Maybe the GDP data is a bit fake, and maybe the government has been grabbing whatever wealth has been created. So I think these two problems have been happening. Bottom line is, the Chinese just never got to a successful equity market, and you could not have done that equity index performance through that last 30 years, 40 years in the way that we have been describing. And then that really boggles your mind. Further, the Chinese government blocked the money of the people of China. You couldn't take it out because of capital controls. Okay, so this is the worst of all worlds. On one hand, you have a country where equity index performance does not work, and you know, think of the context of this entire episode. There is one argument I keep on making, guys, you should be in the equity index. Well, there is one country where that didn't work, and that is the China model is broken. That the Chinese economy did not take care of its own people in the most important aspect of creating conditions for lifetime financial planning, whereby you can cope with this longevity. And second, to add insult to injury, the Chinese government created capital controls to make it difficult for the people to take their money out. Okay, and this is a terrible state of affairs in China. I think it creates a psychic problem. How can you be comfortable at age 50 if you don't see a path to lifetime financial planning because you're going to live to 80 and 100? Okay, this is a hole in the heart of the Chinese people, and that is something that is really harming the country today. It has one more tangible consequence, which is everybody in China idiotically buys real estate. Okay, they have reached a crazy level of overbuilding of real estate to the point where they have so many houses in the country, it is impossible that those houses will ever be used. Okay, that's another dimension of how the China model is broken, but these pieces are all interlinked. So the Chinese failure to get to that ecosystem of the firms and that successful equity market and the investment pathway of equity index funds militates against the most fundamental features of human life, which is life cycle financial planning. That what is this miracle economy which has just damaged the lives of households who are basically stuck? They don't get equity index investments, they don't get the ability to take their money out of the country, they get the ability to buy real estate, and the Chinese real estate market is the worst real estate market in the whole world. What kind of mess has this country created? And they call it a successful economy. It's like, please look at it from the viewpoint of the people, not the state. You know, the state may have some swagger, but we create a country for the benefits of the people, not for the arrogance and the pride of the state personnel. And then finally, we come to India. Okay, so in India, there are important capital controls that interfere with the ability of the people to take their money out. Mercifully, they are solvable. So Mother has made it as difficult as possible for you to get your money out, but you can get your money out. Okay, so you need a lawyer, you need a bank, you need an advisor, you'll need to jump hoops, but in the end, it can be done and it should be done. So you're not as trapped as you are in China. And we got the ecosystem of the firms and the equity market going. Okay, so gentle reader, you would have seen the EIE episode, The Journey of Indian Finance, and I have a paper by the same name, and I'm very proud of the amazing successes of the Indian equity market from about 1991 to about 2009-10. We got some miraculous progress on the working of the Indian equity market, and the firms of India came up very well. We got a genuine private sector. We got great high quality firms who increasingly participated in globalization. We have made an episode on firm internationalization. Okay, you have to get that word tripping off your tongue, Amit. Internationalization.
Internationalization.
Did you fumble that?
Internationalization. Intentionally internationalized.
So in India, we are a bit better off, but this is a striking feature of the hole in the heart of what went wrong in the China model. That all this government control and state on top had this choti si consequence that it damaged the life cycle planning of the people, and that's a catastrophe. Like there are few things as important to human well-being than getting the right pieces of your life cycle financial planning.
So if you're watching this from China, I have a deal for you. Rather, I have a proposal for you. You send an apartment my way or a full house, a country villa perhaps, and I will share the password of my Zerodha account. How's that? So Ajay, among the great unknown unknowns of the future really is how is the state going to treat me? What is the government going to do? So as citizens, what are the things that we should demand from our governments?
In this story, here are the list of things that we want from the government. The first is inflation control. All financial planning goes out of the window if you get one bad bout of inflation. Okay, so if you have 10% inflation for 4 years, you've knocked out 50% from your portfolio. So inflation is a curse, and we have made EIE episodes on the role of inflation targeting. We need to just absolutely pour concrete on that. That when you create a fiat money, when you create the Indian rupee, you are legally accountable to deliver 4% inflation. And they must just get a bullseye year after year of delivering that precise 4% inflation. Not too low, not too high. How am I going to make plans on a 50-year horizon without that sense of certainty? So the greatness of an advanced economy is that sense of certainty that since the early 1980s, there has not been a big inflation in any of the advanced economies. We in India are at early days. The inflation targeting framework only came on the 20th of February 2015. So we're about 10 years into it. And now for the next 90 years, Mother has to prove her mettle by giving us sustained inflation performance that year after year deliver. And that's how people will get stabilized. Otherwise, you're thinking of crazy levels of uncertainty. The second piece that is required is we should not have a fiscal crisis. Okay, so governments collapse when there is a fiscal crisis. Then the policemen don't get paid, and the fire department stops working, and basically all hell breaks loose. And that is the second aspect of macroeconomic stability, that a government should live within its means, not run deficits, just pay down its debt, hold a low debt GDP ratio. Okay, so by and large, the Indian debt GDP ratio is about twice as large as it ought to be. So, our dream for the next 25 years is that the government should pay down debt and reduce the debt GDP ratio to about half of where we are today and create fiscal stability. So again, people get that calm, they get that safety. India is currently not considered an investment opportunity of great promise for government bond investors all over the world because the fiscal situation of the government is not so great. And the third part is societal stability. You want law and order. You want the basics of society, that it should not be a civil war, there should not be a riot, people should not get killed on the streets. Okay, so these basics of ensuring law and order, safety, rule of law, and violence is equally bad whether it comes from a gangster or it comes from a government person. So high levels of interpersonal violence are dreadful, and what we want is a rule of law. We want personal freedom, we want safety, and then you've got conditions of safety for the long term, and we can make plans. Then I can be in this country and I can be sure that I will be protected. I do not have to fear a gangster. I do not have to fear a government employee, and there can be safety and certainty in our life. Okay. The next piece that a government needs to work on is a well-functioning system of firms and finance. That you want the firms to work properly, you want the financial system to work properly, and it all leads up to the fruit of all these labors, which is the equity market. So we want those index funds to work correctly. So an index fund built out of 500 firms is the fruit of the labors of the entire richness of the equity market. It's about electronic trading and algorithmic trading and financial derivatives and foreign investors and financial regulation, regulation against market abuse. The whole institutional complexity and richness is required so that in the end, the fruit of the labor is that an individual should be able to dumbly buy an equity index fund and forget about it, that you should not need to know. That is the glory of a successful country, that the people get to free ride on all this hard work, that there is a great equity market, there's a great system of firms, the regulation works correctly. Okay? And we've made progress in India on this, but there are many hoops to jump. And in our story of the journey of Indian finance, we tell a story where there was a big push in the beginning and then the whole thing petered out. And it's important to get back on that journey and make sure that the system of the financial markets actually works out correctly. And finally, I come to global diversification. Capital controls are immoral. How dare a government tell you to accept an inferior risk reward trade off on your portfolio? That's it. I just question it. It is immoral. The purpose of being a good country is to create conditions for human flourishing of the people. Okay, the state has no right to do things that interfere with the life possibilities of each person. So the people should be able to hold their money in the top 20 countries of the Freedom House list, putting 5% into each of those countries. And thus they've got a safe, globally diversified portfolio with a superior risk reward ratio to anything that is attainable in the narrow walls of the Indian equity market. This is in the interests of the people, and it is completely immoral when a government interferes with the optimization of the people. It's as bad as telling you that a certain vaccine cannot be given to you because it is imported. It's like, who are you? How dare you? Okay, I want a vaccine against dengue fever and I should be able to import it. How dare a government come in the way and say that no, this vaccine we will not allow you to have?
So I have one quibble and one suggestion. And the quibble is with the word societal. Like, this is a bugbear. People can just say social. Why do they use the word societal? There's no difference between them. And my theory there is that it's just become a term, a fancy term used in academia for people to think that they are saying something profound when they talk about societal breakdown or societal shifts. And I'm like, no, just say social, use a simpler word. Don't try to be fancy. So it broke my heart, Ajay Shah, to see you fall under the sway
Indulging,
of that.
indulging in academic
Yeah,
speak.
that poor practice. And my other suggestion is that, listen, we can't trust the state. You know, inflation targeting hoga ki nahi, kisko pata hai. The way out, gentle readers, is this, that Ajay and I have a scheme. We are introducing a new cryptocurrency. We can call it everything coin. Yeah, we're going to introduce everything coin. Details will be in the show notes. So kindly invest in everything coin and you will be fine. We are not going to keep printing everything coin. We've got an algorithm figured out. We can't tell you about it because, you've got things to do in your life. You don't have the bandwidth, So you just do what you're doing, but everything coin is there with you. So Ajay, Excel sheet. Tell me about the Excel sheet which is in the. Yeah, it's there in the show notes. Tell us about that.
I'm going to help you make calculations around equity index performance, diversification, reward to risk ratio. Okay, so this is the essence, that holding periods, long time horizons, what kind of performance do you get out of the equity premium, and most important, can you do some risk reduction through more intelligent diversification? I'll just show some calculations that will help you to see it. A Microsoft Excel spreadsheet is not the greatest way to do this, but I will do what I can. There may also be some R programs.
So Ajay, on this subject, I have no recommendations. So while you're talking, I'll think of something to recommend. But go ahead.
My recommendation is Stocks for the Long Run by Jeremy Siegel. It's a grand book. It gives you this basic fundamental intuition of 200 years of equity index investing, and everybody should read it and internalize the message deeply.
My recommendation is Led Zeppelin. Invest in great music. That's what you did, right? You've got a CD of Led Zepp 2 right beside you. You invested in great music. Unfortunately, the CD is worthless, but the music remains with you and it has shaped you and it has made you the man you are.